Good afternoon, ladies and gentlemen, and welcome to Sasol's Financial Year 2020 Interim Results Conference Call. Today's call will be hosted by Fleetwood Grobler, President and Chief Executive Officer, and Paul Victor, Chief Financial Officer. Following the presentation, an interactive Q&A session will take place. I'd now to hand the conference over to Mr. Fleetwood Grobler. Please go ahead, sir.
Thank you, operator. Good afternoon, everyone. This is Fleetwood Grobler speaking. Thank you for joining us this call, during which Paul Victor and I will discuss Sasol's financial results for the 6 months ending December 2019. Other members of our management team will support us during the Q&A session. We have published a slide presentation of our results, which you can download from the Investor Center on the Sasol website. In the interest of time, we will not focus and discuss all slides, as we would like to make more time available for your questions. Before we begin, I would like to refer you to the safe harbor note on the forward-looking statements contained on slide 2 of the presentation. At the time of my appointment, I said we needed to prioritize some practical short-term objectives. In short, we need to be realistic around the challenges we face, focus on the issues within our control, and start to deliver on the expectations of all our stakeholders. It has been almost 4 months since I took the reins, and so I want to share the work we have been doing. As you know, the industry has faced intensifying macro headwinds over the last few months. Sasol has not escaped these, and the challenges we have faced are reflected in the results we are announcing. But this macro volatility has served only to intensify our focus on improving the factors within our control, and there is much to deliver on. So let me start with a recap of some of my key focus areas in these first few months. I was clear at the outset that we need to focus on delivery in order to rebuild confidence. We delivered a satisfactory operating performance and performed well on areas such as working capital management as well as cost containment. Admittedly, there are many areas in which we can do better. Frankly, a satisfactory performance is not good enough. We need to focus on areas such as delivering efficiencies through continuous improvement, making more changes to optimize the cost base and working capital. Thirdly, we need focus on the transformation of Sasol's culture. I have introduced changes to deliver the key behavior shifts to progress our improved culture, and I'm personally committed to setting the right tone from the top. Finally, sustainability remains a critical focus to position Sasol for the future. Our vision for sustainability also needs to consider the significant stakeholder ramifications, and our intention is to give a full update at our Capital Markets Day later this year. With that context, let me move on to the business performance over the last 6 months. The safety of our people and contractors that service our business remains a key priority, and the tragic loss of 2 of our mining colleagues has been most difficult, and efforts to address safety risks are continuing. Moving to our operations, a solid performance has been delivered across the business. Slide 7 highlights the regional performance of our operations across the globe. We have pockets that are challenging, such as mining, and the productivity turnaround plan is underway to address this. In North America, the LCCP units in operations are ramping up, and the cracker is performing well after the catalyst change in the acetylene reactor section. Our Eurasian production has been lower in response to the lower market demand, offset with volumes from the new ethoxylation unit in China. This unit's operation has been impacted following the coronavirus outbreak, and the seriousness and duration of the impact is as yet unknown. As a final point, let me stress that although we are in the peak drilling phase, we are taking care not to cut corners that could compromise asset integrity. Now turning to the LCCP. There is no escaping that the past year has presented considerable challenges, including more recently with the incident at the LDPE unit. The delays in the LDPE unit startup were a significant disappointment, but those issues are isolated. The root cause of the incident established that the piping support structure within the LDPE emergency vent system failed during commissioning, causing the pipe to dislodge. Remediation work is underway. However, some of the high-pressure piping material components needing replacement have long lead times, and beneficial operation for the LDPE unit is expected in the second half of this calendar year. The cost of the restoration project will mostly be recovered under our insurance policy, and the overall project cost guidance of $12.6 to $12.9 billion remains intact. We are well on track for completion of the project and are rapidly nearing the end of the capital spend, and about 80% of the project's total installed output is already online. It is noteworthy that in the second half we expect to reach an all-important turning point as we see a positive EBITDA contribution from the LCCP. Management remains focused on near-term actions and controllable factors. Our financial performance has been impacted by the downturn in the macros, which has resulted in soft pricing across the portfolio, and EBITDA has decreased by 27% to 19.6 billion rand. Our normalized cash fixed cost increased below our targeted 6% inflation level, and our capital spend has declined as we near the end of the LCCP's construction. With our debt levels consistently within our guided range and decisive measures taken to protect and strengthen the balance sheet, we have made the tough decision to pass the interim dividend. Regarding our balance sheet, we are working hard to protect our investment grade rating, preserve asset integrity, and restore dividends as soon as we can to allow shareholders to benefit from the anticipated positive earnings. Meanwhile, we are making changes to improve our culture. Culture change inevitably takes time, and we have some way to go. As part of this journey, we are ensuring and advancing change readiness at leadership levels and across the organization. While it is critical that we optimize the efficient running of the business in the short term, we have to position Sasol for a sustainable future. In parallel, work is underway to create a framework which will guide us in building a robust Sasol. Part of this framework entails improving our competitiveness, embedding our culture change, and responding to our sustainability challenges. To this end, we are committed to delivering a sustainability roadmap and an update to our broader business strategy at our Capital Markets Day at the end of this year. Let me hand over to Paul to report on our financial performance. We will then open up the session for questions. Thank you.
Thank you, Fleetwood.
Hi, sir. I think your line might be muted.
Hello, is it clear?
It is now clear. Please go ahead, sir. Thank you.
Okay. Thank you, Fleetwood. Good afternoon, ladies and gentlemen. It's my pleasure to take you through our financial results for the interim reporting period. Firstly, our results were negatively impacted by the difficult macroeconomic environment. In short, we faced a 9% decrease in the rand per barrel crude oil price, softer global chemical prices, and low refining margins. Against this backdrop, I'm pleased to report that our volumes, cost containment, and working capital levels were mostly tracking our internal targets. Our mining business, on the other hand, experienced a very difficult second quarter, which negatively impacted our results. Mining is a key driver for the integrated coal to liquids chain value chain. As per our guidance, we have managed our balance sheet debt levels to below our newly approved bank covenant levels, with gearing at the upper end of the guided range provided for in December 2019. We have peak gearing and will now commence the transitory phase of deleveraging the balance sheet as the LCCP's construction is coming to an end. The commensurate cash flows from the LCCP will now start to positively impact EBITDA and flow through to the balance sheet. Very important to note that this will, however, be a very gradual process, and it's particularly important that we continue to protect and strengthen the balance sheet by focusing on the controllable factors at our disposal. We have been able to effectively manage most of these levers in the past and are committed to do so in the future, especially in the current volatile macroeconomic environment. We are also advancing our portfolio activities as we are progressing currently to achieve above 25% level of the $2 billion target previously communicated to the market. In this process, we will continue to safeguard the long-term shareholder value while still aligning our portfolio to the company's long-term strategy. On slide 13, we share the group's profitability. Adjusted EBITDA decreased by 27% or 19.6 billion rand, largely due to the macroeconomic environment, the LCCP startup losses incurred, and the lower than expected performance from our mining business. The decrease in cash generated by operating activities was limited to 21% or 19.6 billion as a result of the proactive cost and working capital management activities. Earnings were also negatively impacted by the increase in the LCCP depreciation and the interest charges now charged to the income statement as a result of almost 80% of the LCCP units being operational, which is very much in line with what we've messaged to the market before. Previously, we would have capitalized the interest to the balance sheet, and because of these units achieving beneficial operation, those interest charges will now follow through to the income statement. For these reasons, earnings per share decreased by 73% to 6.56 rand per share compared to the prior period. Core headline earnings per share was 9.20 rand per share, down 57 compared to the prior period. We expect the second half earnings to be much improved as we anticipate a much better revenue cost matching from the LCCP as it increases production and sales volumes and as capital spend comes to an end. Macroeconomic factors reduce operating profit by 39%, as shown on slide 14. Turning to the items within our control, total costs reduced operating profit by 19%. However, as stated before, this is mainly as a result of the LCCP losses due to high depreciation and operating costs. On a normalized basis, our cash fixed cost increased by 5.4%, which is below our 6% inflation target. The benefits of higher sales volumes, mainly from the LCCP, had a positive impact of 9% on the operating profit. We do expect further positive contributions from the LCCP in the second half of financial year 20, with a significant uplift in earnings expected for financial year 21. Our capital expenditure for the period amounted to 21.4 billion, of which 10 billion rand or $647 million relates to the LCCP as depicted on slide 16. Our capital expenditure forecast of 38 billion rand for financial year 20 is sufficient to sustain the foundation business and to support the final execution of the LCCP. I need to reiterate that we have stayed committed to our capital allocation framework and will ensure that the operations and asset health is not compromised. We have limited growth capital significantly to the LCCP's completion and the Mozambique drilling activities. Going forward, we forecast 30 billion rand of capital expenditure for financial year 21. Turning to slide 17, it shows that our gearing is at 65% and our net to EBITDA is at 2.9 times, which were within the bankruptcy covenant levels of 3.5 times and the market guidance on gearing of between 55 and 65%. The increase in gearing from financial year 19 was impacted by the adoption of the new leases standard IFRS 16, which added 4% to our ratio, coupled with the impact of the LCCP. We have reached peak gearing and have started, as I've said before, the transitory deleveraging phase of the balance sheet. Careful navigation of the balance sheet's deleveraging will be required for a period, and we have limited headroom. Our objective remains to maintain our long-term gearing range to between 25 and 35%, and the net debt to EBITDA ratio to be below 1.5 times. Protecting our investment grade rating remains quite essential. Over time, we remain committed to increase our dividend payout ratio to a targeted rate of 45% or a 2 times dividend cover, allowing shareholders full participation in our cash flows. Again, very important to note that as soon as the balance sheet starts to deleverage, the first port of capital allocation will be towards the increased dividend. It's also quite important that we obtain and maintain an effective capital structure for the balance sheet. More specifically, over the course of the past couple of months, we have refinanced the asset-based LCCP loan with several other financing instruments in place. We have staggered the debt maturity profile to better match the cash generating ability of our assets. We currently have a liquidity buffer of around $3 billion, which allows us to complete the remainder smaller portion on the LCCP in terms of capital spend, but with sufficient headroom to withstand further macroeconomic volatility. We will continue with our fit-for-purpose hedging program to mitigate against any market exposures which we may experience. We are committed to take all prudent actions necessary to ensure that we manage our balance sheet to the targeted gearing levels over the short to medium term. Very important to note that also in line with our capital allocation and to protect the balance sheet, we did take the very hard and tough decision to also pass the interim dividend. In terms of our outlook per slide 18, financial year 20 and 21 are probably the most critical periods for Sasol. Macroeconomic volatility is expected to continue, and within this context, we expect the following delivery from our assets. Mining to ramp up to targeted production levels as we focus on safety and efficiency. Performance chemical sales volumes is expected to increase by between 7 and 9%, and average US dollar margins will trend in line with the global macroeconomic outlook. The increase in volumes on the performance chemicals is mostly as a result of the contribution of the LCCP units, and without that, the performance on sales volumes are flat on a year-by-year basis. Base chemical sales volumes are expected to increase by between 15 and 20%, and excluding the LCCP, we still expect a 1 to 2% increase in sales volumes. Whereas dollar basket prices are also expected to remain soft given the ongoing trade wars and the potential impact of the coronavirus. South African liquid fuel sales volumes will range between 57 and 58 million barrels, with Secunda Synfuels operation forecast to achieve production volumes of between 7.7 and 7.8 million tons. An average utilization rate of between 55 and 60% is expected due to the extended planned shutdown during the second half of the year. Our expectations for the chemicals and energy business does come with a health warning and can be revised as the full impact of the coronavirus is fully understood. Our balance sheet leverage is expected to be in the range of between 2.6 times to 3 times net debt to EBITDA, as per the covenant definition agreed with the banks, and the gearing to remain within our previous guidance of 55 to 65%. In conclusion, we continue to face significant challenges as a business, and with our focus on the key actions required at this point in time, I am confident that we will be successful in managing this critical phase in the history of the company. On that note, we can open the floor for questions and answers, which will be facilitated by Fleetwood Grobler. Fleetwood, over to you.
Thank you, Paul. Operator, we now open the floor for questions.
Thank you very much, sir. Ladies and gentlemen, at this time, if you'd like to ask a question, you're welcome to press star and then 1 on your touch-tone phone with the keypad on your screen, at which time you'll hear a confirmation tone. Following this process, you'll place in the question queue. If you decide a question has been addressed and you wish to withdraw your question, you're welcome to press star and 2 on your touch-tone phone to remove yourself from the question queue. Just a reminder, if you'd like to ask a question, you're welcome to press star and then 1. The first question comes from Chris Nicholson of RMB Morgan Stanley.
Fleetwood, good afternoon, Paul. Thank you for the call. My questions all really revolve around the balance sheet. So I've got 3 sub-questions here. So your guidance would indicate that where we are at the moment in terms of 2.9 times net debt to EBITDA and the gearing levels should be very close to the peak. We're already 2 months into this year. Could you give us a feel for how confident you are that we will actually start to see some of that deleveraging come through in this half, or should we expect potentially this half to kind of tick along close to current levels? That's the first one. Linked to that, clearly there's a lot of concern around the global demand environment at the moment. Maybe what would be help is maybe some sensitivities around rand, oil, or whatever other metric you think is useful in terms of where we wouldn't stop, where the balance sheet wouldn't deleverage and could actually start trending in the wrong direction from here if some of those demand concerns do play out in product pricing. And then just finally, I know you have mentioned in your presentation that you would expect to explore further prudent measures to kind of protect the balance sheet. It looks like a lot of the obvious things in terms of passing the dividend, working capital measures have already been taken. Other than accelerating asset sales, is there other things available to you that you could do? Maybe if you could just help us on that. Thank you.
Okay, good. Thank you, Chris. I'm going to ask Paul to deal with the first question.
Good afternoon, Chris. Nice speaking to you. So yes, Chris, I will basically be obliged to say that the gearing levels that we've seen at year-end, the 2.9 times and 65%, on the one side, what did work in our favor was effectively that the rand did end off in December at around about 14 rand to the dollar. So the conversion impact of the debt to rands ultimately was more positive than if you do the same sum today, where the rand sits about 15. And I think for Sasol, it's always important to consider what that translation impact will be or may affect debt. But if one exclude that in this argument and argue further to say, what do we expect the underlying EBITDA performance of the business to be? Because that really talks to, the cash flow generating ability other than valuation impacts at period ends. And your question then to say, can we see some positive green shoots in terms of the first 2 months of the year? Then we can argue yes. The month of January was a very good month for Sasol, and the EBITDA realized for January far exceeded any average performance that we've seen for the first 6 months of the year. We've got no reason to believe that January will be any different in the sense that we also expect a very robust performance on EBITDA in terms of that. The health warning that I did issue was that we are not inclined currently to give a firm view on Corona, as it really needs to be fully understood. And based on what we know today and based on the factors today, we have seen an uplift in our EBITDA run rate using January and February as a proxy. I think the second thing is in terms of our EBITDA that will significantly shift is that we have made losses for the first 6 months on the LCCP EBITDA losses. January was the first month where we broke even, and February is the first month where we start to anticipate a significant uplift in the EBITDA of the LCCP. So to say that it will kind of push us, on a run rate base to within that $50 million to $100 million range. And that in itself is a significant shift also to our EBITDAs. So the long and short would be to say, I will not be able to answer you exactly where the balance sheet will end off at the end of the year. We are very comfortable with our EBITDA run rates, but let's watch the closing conversion rate in terms of the debt levels, because that can have an influence. But what we see now is we're still very comfortable in terms of today's rand per barrel rates where our EBITDAs are planning out. In terms of your second question on sensitivities, and again, I think it's quite important that macroeconomics can, over the next 4 months, have an impact on our balance sheet gearing. I will say that for the first 6 months, if we argue that we start the half year, the second half at the 1st of January, then we can sustain oil prices on a rand per barrel basis of, say, above 800 rand per barrel, there or thereabouts. So the run rates that we've seen so far is on average around about 850 to 860 rand a barrel, which is higher than kind of what we can sustain. So ultimately, very much comfortable with where things are at, although we're still being extremely tight. We will ultimately also consider from a hedging perspective, taking potential protection out on oil, although our rand and ethane coverage ratios are quite high, which gives us still some protection, but we will consider specifically in the first 6 months of the next financial year, some protection against oil below, let's say, $55 to $50 in that range. In terms of prudent measures, you're 100% right. I mean, we are really kind of pulling all the management levers to our disposal. I think we've been quite successful in the sense that we have been able to manage costs within our inflation targets. The working capital is a very strong positive trend towards the 14 to 15% working capital to turnover. Our capital allocation is really just to sustain our business, so we're quite frugal in that space. And obviously, we need to also push harder on our asset optimization, and we start to see some fruits bear on that perspective. We do believe if we push these levers quite consistently, that it should get us over the line. And we've done that in the past, and we'll continue to do so forward. There's actually no other measures currently that we want to pursue other than this. And obviously, managing the optimal debt maturity on the balance sheet is quite essential. So there's a couple of actions that I cannot talk about right now, but ultimately we'll also push that to make sure that we have the sufficient flexibility. I think the last point is, Chris, is that we feel very comfortable is that our access to liquidity. So even in the event of a potential downgrade on South Africa that may impact us on Moody's, we do believe that our liquidity position through the cycle is actually quite strong. So yes, there's many balls in the air that we need to manage, but hopefully it answers the questions that you've asked.
It does. Thank you, Paul.
Thank you. The next question comes from... My apologies.
Please go ahead, operator.
Thank you. The next question comes from Gerard Engelbrecht of Kronos Research.
Good afternoon. Thanks for the opportunity. Couple of questions. Fleetwood, you talk about a piping structure that failed at the LCCP, leading on to the explosion. Have your investigations uncovered why this has happened, and maybe dig a little bit deeper into that? I'm quite curious as to where the sales of the LCCP product, the polyethylene and the MEG that you're producing. Can you maybe give us an indication of where you're selling those products, local markets, domestic markets, maybe Gemini as well? And then I just see in your analyst book, it looks like you've downgraded your EBITDA guidance for the LCCP from about $1 billion to $700 to $900 million, $100 to $300 million down. Is that downgrade just a move in recent prices, or is there anything else in that downgrade?
Okay, thank you, Gerard. So I'll deal with the first question. So with respect to the root cause analysis that we have completed recently at the LCCP for the LDPE plant, we've gathered a lot of information. We've used all the experts and the licensors and all the company that was involved with that section of the plant. And I think we surmised that we know exactly what is the cause of the failure. As you can imagine, at this point in time, we are busy with insurance dealings. We're busy with the commercial contracts that has got certain things we need to consider. So I would not like to give you a final exact answer today. Be rest assured that we know what is the situation and that we will pursue all the necessary details through our commercial agreements, as well as there is still the insurance investigation that is ongoing. But suffice to say is that in a plant like the LDPE plant, it is ultra high pressures, and when a upset condition occurs, the emergency vent system is put into operation. An incident occurred during the commissioning, which is quite normal for these type of plants. You can expect a number of those incidents to happen throughout the lifetime of the plant and even every year of running. So the response of how the systems reacted in terms of the incident that occurred, it worked exactly as intended. And the only thing that we are very disappointed about is that a component then failed during such an incident of pressure release. So that's as far as I would like to give context. In terms of that, rest assured that we do know and that we would be able to remedy the situation in terms of that part of the plant. With respect to the sales distribution and where we sell it, I'm going to ask Brad to give you context there.
Hi, this is Brad Griffith. Thanks for the question. Can you hear me clearly?
Yes, sure.
Okay. Yeah, you asked about, let me speak with Gemini first. That's the plant that's been up the longest in this value chain. We continue to see good placement of the high-density polyethylene in the domestic as well as the global markets, and we see good demand for the grades of those products that we're making. And I think, as Paul mentioned earlier, we're very pleased with how that plant is operating, and it's been above our expectations for this year. As for linear low-density polyethylene, also very good placement of products globally. We've seen continued improvements in our production rates and quality, which allows us to participate competitively with our cost base there in piping and film markets. So again, really good customer base in excess of 800 customers for linear low density. The OEG plant is also running well, and we've been able to place all of our MEG. I think we've disclosed previously that we have an exclusive distribution partner for MEG that's not focused only on fiber resin grade, and so really no issues placing it. Of course, as Paul has mentioned, we're also monitoring the coronavirus. We're not exposed to China with our sales, but obviously any impact that we see there can disrupt the global markets, and we continue to monitor that. We've recently started up the ethoxylates unit, achieving beneficial operation in January, and we're very happy with the way that unit's operating, and we're now integrating the production of those ethoxylates into our global network.
Thank you, Brad. Sorry, just to follow up on that, and all the ethylene that you're producing in the absence of the LDPE plant working, can you place that easily?
Yes, thanks for that. Yeah, for sure, we're well connected on the pipeline system. So in this period that we're waiting for the LDPE plant remediation to be completed, we are able to place the ethylene, and with the current state of the ethane pricing, we're still seeing good margins on the ethylene merchant sales.
Thanks. Sorry.
Okay, thanks. So Gerard, with respect to your last question in terms of the EBITDA guidance, so we can confirm that nothing changed in terms of our outlook in terms of ramp-up, etc. That's still, as we've indicated before, barring the LDPE that we see getting online later this year. However, the impact largely has been our revised price decks from the industry experts that we've been using in our forecast.
Thank you. Thanks, Fleetwood.
The next question comes from Harsha Papu of HSBC.
Hi. Thank you for taking my question. Could you give us a little bit more detail on the disposal program, please? You've had these targets in place for a while now, and progress today has been rather slow. So do you have any concrete targets or timelines in terms of what you're looking to sell and what proceeds we can expect over that period? Great. Thank you.
Okay, Asha, thank you for the question. So again, to just recap, we started our asset review process in 2017. We had a very thorough and robust assessment of all our global assets. It counts over 100 of those. We have determined that the various assets are, categorized in the various classifications that we've assessed, and we are busy with that program. So at this point in time, we've indicated a number of assets that has been successfully divested, and so we also indicated that we are tracking that this financial year we still would see to realizing 25% of the so-called $2 billion we've announced last year. So whilst that program is ongoing, we would not comment on specific divestments that is under review at this point in time. When we're ready, we will communicate to the market with that, on that. But rest assured that we believe we are still on track for the 18 to 24 months we've announced last year to reach this 2 billion target in terms of our divestment process.
Thanks.
The next question comes from Alex Comer of JP Morgan.
Hi guys, thanks for the opportunity to ask a couple of questions. First of all, you talked to $3 billion liquidity buffer. I mean, there have been some rumors about potentially having to have an equity issue. That looks unlikely to me. I wonder if you kind of want to comment on, where that would lie in terms of priorities and how safe the dividend is for the year end. Maybe also you could let me know how the 2.9 net debt to EBITDA calculation is worked out, because obviously when you do it from the numbers we see, the ratio is much higher than that. Sort of what the gaps were. And then also just regarding the LCCP, can you help me with regard to run rate? You're talking about 50 to 100 million this year, and then 600 to 750, I think, for next year. So, where will you be, let's say in June? Do you think your monthly run rate EBITDA would be at the end of this year? And does that then ramp smoothly through next year, or do we see, additional step-ups through the year? So maybe those questions, please.
Thank you, Alex. Paul is going to deal with those.
Thanks, Fleetwood. Hello, Alex. Yes, so basically, Alex, before, I've also heard about the comments being made in the market in terms of equity issuance, which I believe is a little bit premature, given the fact that I think we've been quite clear in terms of what levers we want to pull, what hedging activities we've got in place to protect ourselves. In the past, we did speak to the market quite extensively about, what will trigger a black swan event and what assumptions flows into that. And none of that really has realized. We've also stuck to our guidance in terms of net debt to EBITDA and as well as gearing. And although gearing sits at the upper end of the range, it was still within what we assumed would be a potential outcome. Now, I don't want to underplay that. The world is very volatile, and any significant change in oil prices to, let's say, on a consistent basis below $50 to the barrel can, over time, expose us, definitely. So I will be, quite open to admit that macroeconomic volatility, can have a significant impact, but it needs to be really step changes in macroeconomic volatility for a extended period of time. So let us get more into the specifics. So yes, we have a $3 billion liquidity buffer, and obviously we want to extend that and even make it bigger to ensure that we can sustain these shocks. Again, it comes back to the point that we need to calculate on the run rates on EBITDA per month, because that just kind of puts us so much further away from a potential, kind of breach of our current level. Now, 2.9 times as at the end of the year, it still leaves us with sufficient headroom. And I think what will be quite telling is to say, where do we end off at the end of the year? We've run various scenarios, and the oil prices really need to be, very subdued, well below $50 to the barrel, for us to really remotely get to 3.5 times cover, given the fact that the rand closure rate, doesn't, kind of jump around, very oddly as at the 30th of June. So we feel comfortable that we're doing all we can and drive the controllables to ensure that we stay clear of 3.5 times covenant. I will say that what is important then is towards the end of December is where we have to step it down from 3.5 times to 3 times. And again, the macroeconomics needs to play along. We then believe that the LCCP will start to really kind of mitigate some of these risks that we are faced to step it down. But ultimately, as we get closer to December and we see, in a scenario that it's maybe 3.1 or not 3, then surely we will engage with our bank consortium to see whether we can get a temporary relief or whether we actually can cure the situation. Because remember, if you maybe end off at 3.1 at the end of December, you're still being granted time by the banks to cure the situation. So I don't think one really needs to take a position of being super dovish. However, the question still remains is, in the unlikely event that a perfect storm does dawn on you, are you ready for equity issues? And any company, in terms of our balance sheet, where we have limited headroom, needs to be ready. So ultimately, we consider all options. However, our plan A is, and also with the scenario analysis that we do, is to keep on managing the balance sheet, managing the controllables, and ultimately, if none of it works, we ultimately need to come to the market and update the market in terms of potential equity issues. We really see that, really with a low probability, although the markets are volatile, and hence the health warning that I did issue is we always need to consider that. But that will be only in a case where oil prices are on a prolonged basis quite negative. The second part of your question is to say, how do we calculate the 2.9 times? I'm not going to do it over the phone or over the line. I think the banks are extremely sensitive, for us to disclose this calculation methodology, but just very high level. On the balance sheet side, the operating leases, this IFRS 16, is not being considered as debt or net debt, so we will usually exclude that impact, and that increased our gearing quite considerably by 4 percentage points. So that part you will exclude. On the income statement side, the normal stuff, depreciation will be excluded, unrealized hedging gains and losses, translation, conversions, and I think the one that you may be missing is also the evaluation or revaluation of our employment contributions or employment exposure in terms of the post-retirement benefits. The team can sit with you and show you more in detail, but that broadly is kind of what the deltas between a heuristic EBITDA to the negative EBITDA calculation is versus what we apply. I must say that the banks do issue us with a certificate after they've audited our results, so they're very much in line with that. The last question on LCCP run rate. So currently, you can do the math, but we are around about targeting a run rate of $30 million from February onwards. By the end of June, even all things being equal in terms of the current spot macroeconomics playing out, we'll probably step it up to around about $50 million, and then further step it up as the LDPE and the alcohol units come to a level higher than that. We'll obviously update you as we're carrying on, but by July, we'll probably need to be at around about the $50 million per month run rate.
Just to add to that as well, we are very encouraged with the current run rates of the LL unit, DOEG unit, as well as the cracker. So in terms of our plans, it's tracking well, and we believe that we would be in a full run rate on those high commodity units in the next financial year, and then the other ramp up of the latter units in terms of the ZAG will continue to ramp up in FY22.
Thanks. Could I just confirm, did you say your run rate at the minute is about 30 million?
Yes.
Okay, thanks. Thanks, guys. Thank you.
The next question comes from from Wade Napier of Avia Capital Markets.
Hi, guys. Thanks for the call. A couple of questions from me. How should we think about the trigger within the balance sheet for Sasol to recommence dividend payments? Then secondly, given cost inflation for labor and electricity both running ahead of sort of 6%, what's your sort of line of sight for continuing to achieve cash fixed cost inflation below your 6% per annum level? How sustainable is this for the next sort of 2, 3, 4, 5 years? And then finally, with sort of 80% of LCCP's production units now sort of operational, have the guys already begun to identify debottlenecking opportunities within the broader complex? Thanks very much.
Okay, Wade, thanks for those questions. I'm going to start with your last question first. So with respect to the unit that's in operation, I think we all along said that we have seen the potential for higher than nameplate capacity options. We've seen that is realistic and feasible in our HDPE unit. We've seen that we could run higher than the nameplate capacity, and I don't think we think differently on any of the LCCP units, namely the cracker. We believe it's got upside potential, as well as the high volume commodity units. So yes, that would be a focus. We want to get first stable operations in the biggest portions of the plant, and then we will focus in on opportunities to run above that. And then as a last stage, we will also consider low-cost debottlenecking opportunities as and when that presents itself. But we're very sort of looking forward, and we believe that there is a good potential to see higher nameplate capacities realizing. Paul?
Wade, on your first question, good afternoon, on balance sheet triggers. So I think safe to say that the balance sheet needs to be well below 50%. It doesn't need to be below 40%, but it definitely needs to be below 50% to reintroduce the 36% payout ratio or the 2.8 times covenant. And not covenant, in terms of multiple, in terms of core headline earnings per share. So ultimately, we will keep on monitoring it. Where our balance sheet currently sits at 65%, so it needs to go 15%. So you can do the math. It will probably take us the best of 12 months at least to get to that level, maybe even longer. And the board will want to understand that given the macroeconomic environment and the sustainability of the dividend, that it can be sustained, because we cannot chop around and decide not to pay out going forward. That will not be good. So anything below 50% on a sustainable basis will be the first trigger. And then to step it up to 2.2 times will probably not make so much cash. It's really kind of about the trajectory as well as the sustainability of that. So I suspect that, the timing between the 2.2 times and 2.8 times is not a long distance to cover, but that we ultimately need to make sure that below 50% is at least as a first port of call where we want to be at. In terms of your second question on labour rates, yeah, you're 100% correct. It does put kind of the company under pressure. So any other company in South Africa where we have this inflation rate or labour escalation above that. But we have communicated to you in the past that we drive continuous improvement as a cultural focus through the organization, and we'll continue to do so. So as part of our digital initiatives, we anticipate that, through efficiencies, getting more kind of robotics in our processes, use big data in terms of analyses, it does make our car go faster, and it does allow us to beat inflation on a continuous basis. However, I think we can be more agile, more smarter at it going forward, and there's currently a lot of talk within Sasol to see how do we really kind of step these efforts up going forward. Fleetwood, I don't know whether you want to add anything to this.
I think that covers it, Paul.
Great, thanks very much.
The next question comes from Tom Wrigglesworth of Citi.
Thanks for the presentation. A couple of questions left, if I may. Firstly, on refining margins, they look to have taken quite a step down at the end of the year. Could you share your thoughts on how you see the white product margins evolving through the course of the second half and into 2021? That'd be helpful. And just coming back on this dividend, it's not clear to me. Is the base case that you pay for the final dividend, or is the base case that we have to wait for conditions to improve and then it can be and then a final dividend can be approved? Thank you.
Thank you, Tom. Paul?
Yes, Tom, let me take your final question. Let me be quite clear. I think the probability of us paying a final dividend is extremely remote. Again, as I've messaged, our gearing range is between 55 and 65%. That implies that it's above 50%, and hence for us to reintroduce the dividend at those levels of gearing will not be kind of advisable. And hence, I think you can expect that the final dividend will also be passed, given the current prevailing market circumstances. The board still needs to evaluate it at that point in time. But given where we are now with the facts at our disposal, I think there's a very, very high probability that the final dividend will also be passed. I cannot comment on the next year's interim dividend. That we will assess based on these factors and triggers that Wade asked me about. The second part of your question in terms of the margins, in terms of refining margins, yes, we did see a significant drop in refining margins. It always cautioned the market and saying we are not as bullish on IMO as the rest are. And in our planning, we did plan for a more kind of a very much of the same or even lower scenario on diesel. And then ultimately on petrol crack spreads, we were also kind of very bearish in terms of those spreads. So petrol definitely well below $10 to the barrel for the next 6 to 12 months. And then on the diesel crack spreads, pretty much around about $10 to $12 over the next 12 months. That's really where we see it.
Okay, great. Thank you very much.
The next question comes from Henry Petricott of UBS.
Yes, hello everyone. Thank you for the update. I have a couple of follow-ups, please. The first one, I was wondering if you can give us just a bit of sense of where your chemical prices and the volumes are tracking in the first couple of months of the year, with regards to your guidance for the full year for volumes in particular, before taking into account any impact of the virus for the rest of this financial year. And then secondly, on the startup of the LDP unit, is it fair to assume that it will be a startup towards the end of this calendar year? And if you can remind us of just the ramp-up time for the unit. Thank you.
Can you repeat the last question, please, Henry?
Yes, the second question was around the LDP unit and the precise timing for the startup. Is fair to assume it's going to be towards the end of the calendar year 2020, and also just the ramp-up period for that unit to full capacity.
Okay, thank you for those, Henry. So let me start with the LDPE first. And we've indicated that we have got long delivery time on some of the high-pressure piping components, and that is really driving our schedule at this point in time. So the startup date has been indicated as the second half of this calendar year. So I think we will give the market an update as we get more clarity around how those deliveries are progressing, and we will then update the market if anything change and give you a more focused time if we can improve. We've indicated that we are doing everything in our power to try and expedite that date, because we want to believe that it is possible to improve on that period, and therefore we'll give you a more specific timing once we're ready on a date. So with respect to the sense of chemical prices, we have seen further softness in the market. I mean, the coronavirus at the moment is bringing quite a lot of uncertainty how it will impact GDP. We've seen that various advisors and companies are indicating an impact on the Chinese GDP of up to 1%. That could, of course, have an impact on some of the demand balances. So that is still playing out. But to suffice to say that that's the case in most of our polyolefin type of products. But when we look at our more specialty type of products, we see a much better outlook. One data point in that was that the PKO prices have firmed up earlier this year. Of course, that helps us in terms of our alcohol range products and also where that goes into surfactant applications. And so, therefore, our outlook on the performance chemical side, barring the MEG, which we know is not really going to go anywhere in the meantime, we believe that there's quite a bit of resilience in that part of our product portfolio. So as far as the volumes go, I think in terms of our base business, we've given you an indication of what the sales volumes would look like in our outlook. So I think you can deduct from there what we see is going to take place. And then with respect to the LTCP, I think we've also given a perspective on top of that, what is our outlook. So I hope that answers the questions.
Okay, thank you.
Thank you. Ladies and gentlemen, just a reminder, if you'd like to ask a question, you're welcome to press star and then 1 on your touch-tone phone to place yourself in the question queue. The next question comes from Herbert Karibe of Investec.
Paul, Fleetwood, thank you for taking the question. Can you give an update on the new surfactant plant in China? Thank you.
Okay, thank you, Herbert. I'm going to start off, and I'm going to ask Brad also to come in terms of how the market and what it looks like there. So, first of all, we have had a very successful startup and commissioning of the plant last year, as we've indicated to the market when we achieved beneficial operation. Our ramp-up of the unit progressed very well through the best part of last year, and the impact started with the coronavirus when we returned from our people returned from the Chinese New Year, and then there was a delay in the resuming or the continuing of the operations. I'm going to ask Brad to talk to what we see in the market currently.
Yeah, thanks for the question. So as Fleetwood said, we ramped up the plant through the second half of last year, and really we had done quite a bit of work to prepare the market for the plant. So we saw ourselves ease into the market. So it's a very wide and diverse application base that we see, and so that was continuing to grow well. With the normal Chinese New Year time frame, we would normally expect to see a dip, and then of course, as Fleetwood said and Paul indicated earlier, we're monitoring the situation around the coronavirus. So it's still a bit premature for us to comment on where we see that. We continue to run the plant. We continue to cover some customer requirements, but we're still having to monitor the situation.
Are you able to offer some guidance in terms of the kind of run rates you are seeing you are getting from the plant pre-coronavirus?
Yeah, we've been able to achieve greater than 90%, so really full capacity has been available to us on that plant.
All right, thank you.
Thank you. The next question comes from Adrian Hammond of Standard Bank.
Hi, guys. Yeah, a couple of questions from me. Firstly, for you, Fleetwood, just could you give us some color on the Horizon mining cash costs, which you're guiding up again? Is this something that you can recover from, and how does this impact the rest of the business? And then secondly, on Mozambique, it looks like you've delayed the replenishment of reserves there, that project, towards another year or so. What is the potential impact on your business from that? And then for Paul, just your cash flow capex, trying to reconcile that with your slide 16. You've got some $900 million of LCCP capex, but I work out about $1.5 billion. So could you just give us what the actual cash number is for capex rather than the accounting metric you've given us, please?
Okay, thank you, Adrian. I will deal with the first question. Let me start off with respect to the mining cost and outlook that we've seen so far. Yes, we had a productivity impact at the mining, and as we've indicated, those were driven primarily by a couple of events. One was in terms of our geological issues that we've encountered with one of the mines. Secondly, it was also impacted by heavy rain through the December period, and also the fatalities at the mines that we had also impacted the timing and the focus during that time at those mines during that investigation. So where are we today? We have re-looked. The mining team has really developed a business improvement plan. We call it the so-called Cienza program. The first portion of that program has been rolled out. We plan to implement the first major productivity improvement initiative at the mines at the first mine during Q4 of this financial year. The team has really responded well over the last couple of months. So January, February so far, we could see things stabilizing. So the improvement is already tracking to the recovery of those productivity losses that we've announced in the half-year results. So I think with respect to the cost, yes, it has gone up much higher than we would have anticipated, primarily driven by the fact that we had to buy in some coal and it costed us more to mine. Yet we have also indicated that we will buy in some coal for the rest of the year, just to make sure that we've got a sufficient stockpile and that our reserves is good as we go into labor negotiations and the rest of the activities that go along with that. So, and that will impact, of course, then our mining costs. But as I said, we've got firm plans to remediate that productivity lapse, and that will then restore most of the costs that we've seen be increasing on the cost per ton of coal mined back to the normal levels that we were pursuing, around 320 to 340 rands per ton. So with respect to the Mozambique PSA gas project, I think suffice to say that we are progressing that further. We have approved, the board has guided us to go through the basic development phase now. We're on track. We delivered the field development plan in February to the Mozambican authorities. We are planning to go further and develop the project through to the latter part of this year to get us to a point of a final investment decision. So I think all of those plans, as far as the PSA, are tracking. We're also continuing with the infill welling drilling campaign, and so the plateau and the decline of our existing reserves are being addressed. Now, is it happening as quick as we want it to be? Of course, the answer is no. We would like to make it happen earlier, but all efforts are focused on that, and we believe that we're well positioned to address those.
Adrian, then the last question was on the cash flows for the capital cash flow. So ultimately for the company, on page 30 of the analyst book, in terms of the statement of cash flows, you can see kind of the movement there for the half year. In total, it's 25 billion compared to the 21 billion. I'm just rounding the numbers off in terms of actual expenditure versus cash flow of 25. And then for LCCP, we did quote that it's 10 billion rand or $647 million in terms of actual expenditure, and in terms of cash flows, around about $950 million in terms of capital cash flows on the LCCP. So what you will see is a kind of a significant unwind of the accruals on LCCP as the project is coming to an end.
The capex of 38 for the full year, what's the cash element?
We will share that number with you during year end.
Thanks very much.
Okay. Thank you, Adrian.
We have a follow-up question from Gerald Engelbrecht of Chronix Research.
Thank you. I just see, Paul, on slide 14, you mentioned carbon tax as a cost increase. Did you pay carbon tax in the first half? When and how much? I'm just curious.
Gerald, we haven't paid it yet. We have accrued for it, around about 500 million rand.
Thank you.
And Gerald, has that concluded your question?
Oh, yes.
Thank you.
So, operator, we're going to take a final 2 questions.
Thank you. We have a follow-up question from Adrian Hammond of Standard Bank.
Thanks. Paul, just looking at this may not be material, but I think to the bottom line it is. The external sales from the coal business fell quite materially year on year, although the sales volumes weren't down that much. Was there something in the pricing, perhaps, that we didn't see?
So there's 2 things happening on the export coal business. On the one side, the pricing, the average pricing for the first half was down due to a more kind of subdued international coal prices. However, what we needed to do, as we saw some supply constraints of the running mines into Synfields, that we had to swap over more middlings or export coal volumes to the CTL value chain. And hence you will see the kind of the decrease in volumes to be sold externally, and that more being consumed where you can. You have the flexibility to do so as part of the integrated Synfuels value chain. As soon as the stability on the mines return, we will ultimately then resume a far larger export of export coal to the Richards Bay terminal and ultimately to those destinations that we sell into. So it was really kind of I will say a short-term blip in the way that we try to manage the supply between Synfuels and the Synfuels margins are still much higher than on an integrated basis than what you'll get for coal on the export market. So it makes sense to swing it over.
That's clear. Thanks.
Okay. Thank you, operator. I see there is another question, so we can take that one still.
Thank you very much, sir. The next question comes from Nkanyesi Molasi of Ashburton Investments.
Hi. I just wanted to follow up on the carbon tax issue. Initially, you had guided towards 800 million rands in carbon tax, but you've already paid like 500 million rand. Would it be correct then to expect that for the full year, that would be about 1 billion rand in carbon tax that you've paid? And the follow-up question would be on with regards to the issue related to NESA. I think in your final year results last year, you indicated that there was a matter pending with the regulator. Could you give us an update on that, please? Thank you.
Hello. So basically, the first part of the question is correct. So we have accrued for the first 6 months, the 500 million. So yes. It does make sense to also accrue for the second half. Just again, remember that it's pre-tax, these numbers that we cut. So ultimately, we because it's a cost, we can deduct it for tax purposes.
Okay.
For you?
Okay. On the question relating to NESA, as you may be aware, following the Constitutional Court decision, NESA had to revise the maximum gas price methodology. They issued out a draft discussion paper in relation to that. We have made submissions on it. In fact, there were submissions submitted on the discussions and submissions on the 20th of last week. So we will await the determinations of NESA. And of course, the key point there is around a redetermination of the maximum gas prices. And arising from that would be an assessment whether there is any further obligation from us. So we are awaiting that, and we have made submissions to NESA.
So you're not aware of you can't give guidance in terms of the potential financial impact that it may have on Sasol?
No, we can't do that because bear in mind the first point, the court set aside the maximum gas price. We actually price below that cap. And so we wouldn't know, for example, where would NESA end up coming in relation to the revised maximum price, and whether once it has come down, assuming that it brings it down, whether it would be below the actual prices that have been levied. It may well be that it's a revised maximum price, but still higher than the actual prices levied. And so we can't really speculate as to what that effect would be.
Okay. All right. Thank you.
So, operator, I will make some final concluding remarks, and then we will move and close the call. So, thank you for your participation this afternoon. We are looking forward to engage further over the next couple of weeks as we commence our roadshow from tomorrow. So, thank you for your time and participation. Have a good afternoon.
Thank you very much, sir. Ladies and gentlemen, that concludes today's conference. Thank you for joining us. You may now disconnect your line.